I have been surprised. Here we are in early July, and last year in the third quarter was when you had a gap. It was when, if you look at 10-year U.S. Treasury yields minus 10-year JGB yields against the yen and rising relative yields in Japan at the 10-year rate have stopped. They started driving a weaker yen, not a stronger yen. That's a problem. That's currency crisis behavior. Now, Nikkei is responding that way, right? Nikkei in yen, Nikkei in dollar, Nikkei in gold. That's what you'd expect to see. So that's what I'm watching. That's how I'm thinking about it. And I'm sorry I don't have a strong view on that any given Sunday. Could be tomorrow, could be 5 years. I don't know.
The ongoing structural shifts in the global financial landscape are prompting a critical re-evaluation of traditional reserve assets and economic hegemony. Geopolitical tensions and changing warfare dynamics increasingly challenge established economic assumptions. Luke Gromen, a prominent macroeconomic strategist, author, and founder of Forest for the Trees, emphasizes that the classic belief that the U.S. military ultimately backs the dollar faces severe structural headwinds. He argues that because Chinese factories manufacture critical components for the American military, a secular shift toward missiles and drones fundamentally undermines Western hegemony. Consequently, the rising necessity for defense spending exacerbates an existing state of fiscal dominance. This backdrop proves highly positive for gold over time, as the U.S. experiences a diminishing capacity to enforce absolute dollar hegemony. This dynamic makes a transition to multi-currency oil pricing, particularly in Chinese yuan, far more likely. When these energy transactions net settle at the central bank level, gold reserves will rise, driving the gold-to-oil ratio significantly higher. Now, we present the clips from Luke Gromen's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
I've heard countless times the U.S. military ultimately backs the dollar. We've all heard that a lot. But Chinese factories ultimately make the critical components of the U.S. military. And there's a shift ongoing to missiles and drones. We've seen that in Ukraine. We've seen that in Iran in terms of the ability for the Iranians to stand off the most powerful navy in the history of the world, the United States Navy in the Strait of Hormuz. And that, on some level, undermines hegemony. Let's not beat around the bush. That suggests there's more geopolitical risk overall, secularly. Also suggests more defense spending is needed. We've seen Trump talking about wanting $1.5 trillion defense budget, up from $1 trillion. And that's more spending into fiscal dominance that already exists, with U.S. interest expense plus entitlements, 90 to 100% of receipts, with receipts at near all-time highs. So all of that, in my opinion, is positive for gold over time. And I'm not talking about one day or the next day. I'm talking about positive over time. The U.S. needs to spend more, and it is becoming less able to enforce dollar hegemony at the same time. That's positive for gold over time, in my opinion. It also makes multi-currency oil pricing more likely, particularly in yuan, as the U.S. has less ability to go out and beat people over the head. We just saw we're running out of missiles after a month or two, and then we can pick up the phone. Hey, China, can you make more for us? Certainly the components. So that dynamic makes multi-currency oil pricing more likely, and multi-currency oil pricing ultimately, we've seen it gets net settled at the central bank level in gold. Central bank gold reserves rise with multi-currency oil pricing. That in turn sends the gold-to-oil ratio up. Oil surpluses bidding for gold. Gold-to-oil ratio higher is positive for gold miners. Gold-to-oil ratio is just a proxy, Texas hedge proxy, if you will, for gold miner profitability. And yet, the markets are trading gold miners as if markets do not believe the gold-to-oil ratio, which has gone from 6x to 60x over the last, from 2010, 2008 through 2026, so call it 18 years, up 10x. Markets are trading the gold miners as if the gold to oil ratio is going back to 6, 8, 10x. I don't think it's gonna. Because missiles, drones, and fiscal dominance suggest that gold to oil ratio is going higher over time, not lower. And so the geopolitical premium to me, I think, is just over time higher gold to oil ratio, higher gold. It's better for gold miners. Oil, I think, ultimately, again, multi-currency energy. I think oil stays, all else equal, oil stays in a range of highest marginal cost producer, USA at this point in time, plus 10%, 15% in a range. So 65 to 85. That was my base case, sort of pre-Iran war, and I think I'm sticking with it wherever we are with this conflict. Since China wouldn't be the fleeting country regarding treasury detention, but the one with firm, stable dollar holdings. In my opinion, it wouldn't really change the narrative much at all. U.S. federal debt has risen 8% CAGR since 2008 on average. So that's CAGR means. Come on, Luke. Since 2014, global central bank holdings of treasuries are flat on net. So even if we assume all of Luxembourg and Belgium holdings are China, and probably much of them are, some pretty good authorities on that, like Brad Setzer, certainly assert that, and there's no reason to not believe it, then foreign official demand has still been way below issuance for going on 20 years. And if we move Luxembourg and Belgium out of the private category into the official category, as implied here, then the private category, which has been held out as, hey, look, see, private demand is still okay, has to get brought down. And so you're still at the same point, which is the point of the whole exercise, which is supply of U.S. Treasury. The issue is that there's too much supply of treasuries relative to foreign demand and the inability of the domestic economy to handle the remainder at key times, certainly, without rates rising to levels that start to break the domestic economy. In other words, there's a price at which everyone can afford to buy the treasuries and where you will get that. But that price, that rate, triggers a debt spiral because the U.S. can't afford to pay that much in interest, and the policy rate of the U.S. economy is the 10-year. And the 10-year gets too high, it creates a problem for stocks, etc. So that is really the issue. And ultimately, that is just a function of, look, weaken the dollar, it's less of a problem. Higher nominal growth, less of a problem. Strengthen the dollar, more of a problem. But it doesn't change the narrative at all, in my opinion.
An undeniable oversupply of government debt relative to foreign official demand has persisted for nearly 2 decades. Attempting to suppress this reality triggers a dangerous debt spiral, primarily because domestic economies cannot absorb the expanding issuance without bond yields rising to levels that break the underlying system. If a country chooses to save its sovereign bond market over its currency, it intentionally sacrifices purchasing power to keep debt structures functional. This exact pattern is visible when tracking major equity indices priced in gold versus fiat terms. The real value reveals a starkly flat trajectory masked entirely by currency devaluation. Under these conditions, the marginal cost of energy production acts as a temporary anchor, keeping raw crude ranges bound tightly between $65 and $85. Now, let's get back to the interview.
From CL, what is your personal asset allocation? Of liquid net assets, 20 to 20 of liquid assets right now, 20 to 25% cash and T-bills, 35% gold, 3 to 4% Bitcoin, 10 to 15% U.S. electrical infrastructure. The balance is across broad equity indices and also a bit in life insurance equity at AAA-rated Northwestern Mutual, earning around 6% federally and state tax-free. AI is expected to lead the frontier of discovery across multiple domains, not least that of science. Do you think we should come to expect some breakthroughs in the field of economics? If so, where do you think certain blind spots in economics lie? There are some areas of medicine, for example, that are driven by dogma or profit or CYA, cover your ASS, over actual facts, over actual science. The so-called replicability crisis of scientific research is a perfect example. Google replicability crisis and see what happens. Just think about what happens if you apply AI, hard AI, to replicability crises on some of these scientific discoveries. Will those be allowed to be corrected, etc.? We'll see. As it relates to economics, I think AI will reveal economics to be what it is, right? They are who they thought we were. Dennis Green. Economics isn't a science. It's a branch of moral philosophy. It's about trade-offs. It's about politics. And so to me, the breakthrough that AI may bring to economics may not be one that the economists like a whole lot, which is to say it will give the average person with an interest in economics the ability to solve for political outcomes. Hey, AI, Claude, give me the economic system that you would employ if you wanted to maximize corporate profits and the flow of those corporate profits to the top 1% of citizens. Hey, Claude, how would you structure an economic system to be most equitable to fix the K-shaped economy? Hey, Claude, right? You see where I'm going with this. The economics profession in academia has been able, some of them, not all of them, of course, have been able to hide behind academia and formulas. Call up one of these papers and it's like, sigma and this, like what? It's a branch of moral philosophy. It's not a science. And AI will allow people very easily to see when you have an economist pushing a certain type of economics, a certain branch, you will be able to infer very quickly what they are solving for politically and who they are solving for politically. I'm not going to say more than that. I'll let you pull on that thread. Okay. Next question, final question, from Gyof and from Tom. How high can JGB rates go before they're in big trouble? From Tom, what's going on in Japan? Has the BOJ been intervening and selling dollar reserves to stabilize the yen? This has probably been answered before, but when push comes to shove, will they choose to save the bonds or the currency? So yes, I just saw something last week or so. They have been intervening to manage the rate of decline of the yen. So far, not so good. It's not really doing much, just slowing things down. In my opinion, they will save the bonds over the currency. They really have to. When do we hit trouble? I don't know. This is one of these any given Sunday kind of things. If you look at a chart of the Nikkei priced in yen, looks awesome. If you look at a chart of the Nikkei priced in dollars, looks less awesome. And if you look at the same chart of the Nikkei priced in gold all over the last 5 years, it's like nothing. It's all currency. So they're already sacrificing the currency. When you have the, Nikkei and yen like this, Nikkei and dollar like this, and Nikkei and gold like this, it's the currency, okay? So people are seeing that there's no way out of this thing, that they're going to choose to save the bonds over the currency and adjusting. And the problem is the bond market's getting hit as well. And given that they're a creditor currency, it has issues for the U.S. and for Western sovereign debt, pulling yields up there. Now, weaker yen can kind of manage that, but that also weaker yen pushes higher dollar. Higher dollar, all else equal, pushes higher 10-year yields in the U.S. Higher 10-year yields in the U.S., all else equal, create stresses elsewhere. So it's a very delicate situation. In theory, you can kind of try to manage it, but it's an any given Sunday type thing for me. I'm not trying to guess when, but you just heard me say I got 20-25% in cash and T-bill, and gold. Like, I don't know how or when, but I just look at it and I've been doing this 30 years. I know unsustainable when I see it. So, as long as they don't have a capital flight or sudden stop, maybe they can kind of just keep all the balls in the air for a time. But, that's, any given Sunday, who knows what could trigger that. So, it's I have been surprised. Here we are in early July, and last year in the third quarter was when you had a gap. It was when, if you look at 10-year U.S. Treasury yields minus 10-year JGB yields against the yen and rising relative yields in Japan at the 10-year rate have stopped. They've started driving a weaker yen, not a stronger yen. That's a problem. That's currency crisis behavior. Now, Nikkei is responding that way, right? Nikkei and yen, Nikkei and dollar, Nikkei and gold. That's what you'd expect to see. So that's what I'm watching. That's how I'm thinking about it. And I'm sorry I don't have a strong view on that any given Sunday. Could be tomorrow, could be 5 years. I don't know. In the meantime, though, I would expect you to continue to see Nikkei in yen, Nikkei in dollar, Nikkei in gold, because that's kind of the dynamic that we're seeing.
Navigating this delicate environment requires a resilient asset allocation strategy focused on liquidity and tangible value. Maintaining roughly 20 to 25% in cash and short-term treasury bills, alongside a heavy 35% concentration in physical gold, provides a necessary buffer against systemic instability. Minor allocations to digital assets and domestic electrical infrastructure complement a core foundation of broad equity indices. Looking forward, the integration of advanced artificial intelligence into academic research will likely strip away complex formulas to expose economics for what it truly is, a branch of moral philosophy centered on political trade-offs rather than an objective science. Ultimately, observers should expect a continuation of currency crisis behavior. Share your thoughts about this interview in the comments section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.